Hi, everybody. This is David Skarika. I'm going to get right into this today. So we're going to, obviously it's called Stock Chart of the Day, but sometimes we're going to do something different, and it's just like uh, we're going to look at corporate debt rollover and government debt rollover. This is something nobody's talking about right now. But, I have a book coming out sometime next year. It's been 4 years in the making, believe it or not. COVID happened, and then we had this huge, obviously, boom bubble with all the money being printed, and rates started going up, and then inflation went up. We've all these things happen, and obviously I've had to readjust the book to all these things happening. It's a macro book, and I think actually, and I wanted to wait because when I saw this bubble going up in 2020 and 2021, after I finished the book in 2019, 2020, I was like, I want to see how this plays out because obviously, things are going to change in a year or two. And, so we're going to look at here. So one of the theses of the book is, we're in this big investment court trouble. So you can see this here. I talk about the LQD short, I've talked about that here. So I'm not giving anything away, but I just have the chapter open in the book here. And the reason I have that open is quite simply like I have it open because 1 second, this right now. So I'm going to opening something right now. So I have this open right now because it's the two charts are right next to each other. Okay, so here we go. We can see here. So this is the debt corp that matures. So it basically has to be rolled over. So you can hear my cat there. So you can see this is a real professional show. So you can see that roughly it's between 1 and 1.2 billion, from 2025 to 2028 during those 4 years, and then it's 800 million here and 800 million here and 700 million there. So if you add all this up, let's just do the quick math. I'm gonna round off. This is like 1.2. That actually looks closer to 1.3. So it's 2.5. 3.5, 4.6, 800, 5.4, another 800, 6.2, and then another 700, 6.9. So almost $7 trillion in corporate debt. So it has to be rolled over. And, the investment grade is whatever, so much of that, right? So, but basically, that's a lot. That's 30% of GDP, right? So, look, and I think total debt altogether is something like 12 to 15 trillion in corporate side, depending on what you include in it. So you're talking like almost half the corporate debt, because a lot of times most of this debt is yield short term is cheaper. So and like I showed the McDonald's example a few months ago, a lot of this debt was issued at like 2%. Well, now it's trading at like 5 or 6%. So then the corporations can't pay off this debt. They don't have the cash flow or the revenue stream just to say, okay, well, this whatever, $50 million bill that we issued, we can pay that off. We got to roll that over. And then, on a $50 million bill, 2% to 5% is, 1 million in interest a year to 2.5 million. And that may not sound like a lot, but that's a lot when you add it up with like, dozens of bonds that these companies have, right? So, and of course that interest payment then cuts into cash flows and profits, expansion, potential M&A, whatever the case may be. So, and it's also just more supply on the market on top of like whatever new debt corporations issue, they have to roll this over. So that's why I think that if rates stay higher and this also hits the market, you're not going to see a lot of new debt, being issued. And this is the government debt. So this is the net change in debt at the top in the red and the blue, and the bottom is the amount of debt that has to be rolled over. Now, for whatever reason, the U.S. government is very foolish. Actually, there is probably a reason. Government, people who run the government are the smartest people in the world, right? Is 1 to 3 year in maturity. Now, you think that during COVID, when rates went to zero and the 10-year bond went to 0.5%, they would have said, hey, let's issue these trillions of dollars of debt and 0.5%, lock in at 0.5% for 10 years. But no, they didn't. They did it because basically 1 and 2 year, bonds were like yielding basically zero. So you can see the problem here is they have to, if you add all this up from 2023, so this year into 2030, they have to roll over nearly $15 trillion in debt, or sorry, $10 trillion in debt. And the deficits are now going up again. Okay. And the deficits, after going down for a year or two after COVID, are now going back up, and they're going to average 1.5 to 2 trillion a year till 2030. So let's say they average 2 trillion a year, because I'm going the upside because that's the way the government works. So let's say it's 15 trillion plus the 10 and being rolled over, 25 trillion in debt. And again, that's like, new supply. There's the old supply plus the new supply, plus, the corporate debt that has to be rolled over. So when you got basically 32 trillion dollars of debt, that is north of like 100% of GDP that has to be rolled over. I think it's a huge problem, and it's it's more supply. More supply with not enough demand means prices will go down or rates will go up to attract buying. That means, to me, that even after the Fed probably ends this, tightening cycle in a year or two, ultimately rates are going to be held higher, because there's just too much supply. Which, two ways to get out of it is you got to default on this debt, which is not going to happen, or there's going to be massive amounts of QE, and they're going to have to forget about inflation. They're going to have to buy corporate bonds. They're going to have to buy government bonds. And I think that's when we'll really get, you think this inflationary spiral is bad? That one will be really bad, probably in the latter half of this decade, the 2026 to 2030 period, So I just wanted to show you that. And I think it's something nobody's talking about. Everyone's just so focused on the Fed. They're going to do another quarter point. When are they going to start to cut? No one's talking about the gorilla or elephant in the room, as they say, which is this corporate debt that has to be rolled over. So now we're going to go to Inca One. Inca One had some phenomenal changes, in sales, in deliveries, in sales, in gold production. The deliveries were down a little bit, but I think the production and the sales are obviously the most important thing. So you can see month over month. Now, one reason it changed as much is that some of these sales got diverted into the quarter because of something that happened. You see from the prior month's contracts, right? So, but year over year, it was still, month over month, it was still pretty good. And year over year, it's still even more impressive, So basically, this company, in the end, let's just say, let's go in between. So 1.4 plus 6.2 is 7.6. Let's say they're doing 4 million a month of sales. I've said this before. That equates to 50 million a year in sales. So obviously, there's things like cash flow, when do they become profitable, all of that play into a factor. But you can see the stock is, right at the lower end of its range at around 15 cents. And we're going to go look at Inca One here on Inca One here, and you can see the market cap is 6.1 million. So they're, over the last few months, are doing annualized, let's even be conservative, say 40 million. And the market cap is 6.1 million. Now, these kind of companies, for whatever reason, even Dynacord doesn't trade at sales. It trades at like 60 or 70% of sales. But even if they were to say, again, let's be conservative and say it's 40 million, and we're trading at, 30% of that market cap. And by the way, those sales, anyhow, so the 30 million is a 5x gain from here. So to me, this stock remains, kind of a no-brainer down here. I don't know why. I own some. Obviously, they're a sponsor of Stockchartoftheday. I've marketed for them in the past, but I don't know why it's just considered. It's just probably the nature of where the gold market is right now. But I think this is the kind of stock that, with gold, can finally break that 2100, can really explode in price, because, then their sales will go up even more because gold will be 10, 20, 30% higher, and their margins will go up, and they'll probably start becoming profitable. And remember, once they can acquire this loan, those sales are like, they're at like 50% capacity right now. So those sales can go up even more once they get that mill up to 100% capacity. So I'm going to leave that at that today. Today, we looked at the huge rollover we have to see in debt, and both government and corporate level, and something no one's talking about. And then on top of that, the residential debt. Like, I've told the story about a cousin of mine in Canada who has a huge mortgage, 5-year fixed. He's going to have to renew, I think, in 2025 or 2026. And that's happening to, like in Canada, hundreds of thousands of homeowners. So a lot of people who say did those 5-year mortgages, say 3 to 5 year mortgages during the peak of rates. Yeah. I think they're going to basically 2024 to 2026 again, roll over, and corporations, governments, individuals, none of them can afford that higher interest. So I'm going to leave it at that. And we'll talk later. Hope you enjoyed the stock chart of the day.